Welcome to the Halftime Report, presented by Untitled Trading.
And welcome out to our halftime show here from Untitled Trading. Coach Matt, Coach Tim, it's a Friday, July 27th, 2018. And markets are moving a little bit here, Matt. There's some interesting action going on out there. How are you doing this morning?
You know, Tim, doing absolutely fantastic. Excited to be here this morning or the afternoon on the East Coast. Got a great halftime report planned for everybody. Going to look at GDP, consumer sentiment. We obviously got to look at some of the earnings from yesterday, Amazon, Intel, ExxonMobil, and the like. Looking at a couple stocks that we're looking at as well. You want to talk about Spotify today, and I want to talk about Palladium futures. So we're going to do a little bit of a weekend review type thing on Fridays, kind of looking at the different sectors, what sectors, kind of preparing for next week in the market a little bit, looking at where the sectors are in relationship to where we think they're going to go next week in the marketplace. So I'm looking forward to the discussion today.
Well, Spotify is one of my favorite brands and products that I use. You know, so much about trading is about, using what you know. It doesn't mean you have to trade it all the time. I've not traded Spotify since it IPO'd. I might have taken a swing trade now that I think about it, but it was nothing real big. The reality is it's now 2 earnings cycles in. We're several months in. I'll be interested to get your take on it, see what you think. Yeah. And, obviously when we're going through a Friday routine, Matt, we have to take a peek at the week ahead as well. And we'll do that right here at the end of the show. Go ahead and bring your screen up. Let's get right into the markets. And young Cameron. Ding, 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 ding. All right. Okay, S&P 500's got a red candle up there at the top, Matt. After 5 days, Monday, Tuesday, Wednesday, Thursday, green candles. Now your first red candle for the week. Bringing it back to about 28.20. When you think about the entirety of the week, really still a bullish week, in general. Seeing some pressure here at the end of the week, profit taking probably. Is that what you're chalking this up to?
I'm not just chalking it up to profit taking here, Tim. GDP data came in at 4.1%. Obviously, there's people out there, putting that out there like it's some type of grand, amazing accomplishment. But the simple reality was it didn't beat the expectation. The consensus expectation on GDP data was 4.2%. It came in at 4.1%. But Tim, even with the GDP coming in slightly under 4.1% is a good number. It's a good number for the economy, no doubt about that. But it's important to keep that into perspective to a certain degree. 4% is certainly above what the what the average expectation is over the last 9-10 years since the recovery. But I want to look into this. I want to put you on the spot a little bit, Tim. Couple questions for you. Okay, 4.1%, right? And Trump's came out and talked about that. It's a good number. It's under the expectation. But when was the last time we hit 4%?
Ooh, now that does put me on the spot. I'm trying to think, and that's just quarter over quarter. Is that right?
It's second quarter. It's second quarter 2017 to second quarter 2018.
There's probably been a quarter somewhere in there around that 2013-14 year when we had such a bullish year in the market, all the QE stuff, but I don't think so. Matt, give me an over-under.
I'm putting you on the spot. You were close. It was second quarter of 2014. It was the second quarter of 2014.
Yeah.
Now, the question I have for you is, obviously, once again, a very, very good number. But I want to put this into the proper context, Tim. In preparation for the halftime report today, I went back and I looked at every GDP report since the recovery began. And I put that recovery really kind of at the beginning of 2010, the first quarter of 2010, because we were still negative in 2009. We were negative in the first quarter of 9. We were negative in the second quarter of 09. We were negative in the third quarter of 09. We started a slight recovery in the fourth quarter of 2009. But I went back from where I kind of could year over year from 2010 until today. Tim, I'm going to give you a couple numbers. Number one, we have averaged growing at 2.1%. That's what we have averaged growing from a GDP perspective. In 2010, we grew at 2.7%, 2011, 2.1%, 2012, 1.4%, 2013, 2.5%, 2014, 2.5%, 2015, 1.2, 2016, 1.6, and 2017, we grew at 2.2%. So the best years we've had in the last 9 years were 2010, 2013, 2014. Now, Tim, I'm going to put you on the spot again. Which quarter has the average best performance? First, second, third, or fourth? Obviously, we just got second quarter at 2.1.
Well, thinking about seasonality effects, the stock market tends to do really well in the fourth quarter as we have the Christmas rallies closing out the year generally, and especially during that period, we've had good runs after the 2016. I'm going to say Q1 has the best numbers because we're reporting for Q4, right? Is that how they do that?
No, Q1 reports for Q1. So
okay, so I'm going to say Q4.
January reports for Q4. So April would report for Q1, July Q2, October Q3, and January Q4.
I like it. I'm going to guess January report for Q4.
January report Q4. You would think because of all the seasonality, retail sales, Black Friday, Cyber Monday, all that jazz.
It's Christmas. Yeah, that's right.
It's Christmas, right? That actually grew at 2.1%. It was it ranked third. Okay. Mm. The actual best quarter on average is the third quarter report. And so the third quarter report comes out in October, reporting for July, August, and September. That came in at 2.5%. The second quarter was averaged at 2.3%. The fourth quarter averaged at 2.1%, and the first quarter averaged at 1.5%. So the first quarter, we've had some abysmal first quarter reports.
By the way, all these numbers, all I ever hear is inflation, 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 inflation. If you're growing at 2% on average, you are pacing with inflation.
My whole point of this is when you look at the reading of the number, 4.1%. And if you just looked at the headline from, Bloomberg, Reuters, CNN, Trump's Twitter feed, whatever it is, you would think the market is responding just absolutely fantastically bullish, correct? Mm. But yet most of the market is responding in a negative form, in a negative way towards that number, because the number isn't the most important thing. It's the number versus the expectation. The expectation of 4.2%, Tim, has already been revised downward 2 times in the last month. A month ago, the Atlanta Fed had a 5% number. It went down to 4.8. It went down to 4.3. It went down all the way down to about 3.8 last week. So the 4.1% doesn't tell the exact truth behind it. But if you actually look beyond the number, Tim, okay, what drove the majority of the GDP in the last quarter? Was it consumer spending, corporate spending, or government spending?
It had to be government spending, which is one of the critiques about where we are from an economic standpoint right now. You are decreasing taxes, which is usually good for corporation, but you're increasing spending as well, which is just putting us into a bigger debt hole.
Corporations have not increased spending.
That's right.
They've actually decreased spending. So corporations have decreased spending. Despite the massive tax cut, corporations have decreased spending. Okay. So where did all that tax money go? That tax money went to increased dividends, stock buyback programs, which don't help the GDP, which don't help the actual economy. Consumer spending, consumer savings, both went down quarter over quarter. What increased and what is responsible for the biggest jump in the GDP this year, quarter over quarter, is a massive increase in government spending. And that cannot be sustained. That's why I don't believe this number is going to have any follow through to it. And I think that's what the market sees as well. So the headline number is good, but when you look at the actual raw data behind the headline number, it really tells a different picture, Tim. I mean, you look at the market here, drop it down into a 15-minute chart here. This is when the data came out, right here. This is when the data came out. And as you can see, the market has just been selling the whole time after that number came out. Because the number, if you look at the data, it just can't be sustained. You cannot continually increase in a capitalistic system government spending to offset a reduction in corporate spending. I mean, this whole thing, like, for example, we put tariffs that hurt our farmers by about $12 billion. So what do? We put out government subsidies of $12 billion to offset the lack of spending of $12 billion. Those types of things cannot be sustained from an economic perspective. I'm actually taking the number as a negative today.
Well, the market is as well. That's a red candle. There's no doubt about it. I mean, we're down about 0.89%. By the way, one thing that as a trader, I always look at percentages, and numbers for sure. A 1% sell-off in the market is not going to make me think about institutional selling yet. Obviously, that is a red candle. It's a concern day. It's coming down, but you are still above. I'll make the other side of this though. You're above the 20 MA. You're above the old resistance point. You still have an uptrend above the 50 MA. Obviously, the market does not like this. They're reading it the way you are, Matt. But as you're going into the weekend, does that mean you change your entire game plan to a neutral game plan? Like what are you doing with this?
Of course not. I'm still a bold, positive one, cautious. But as a trader, you could be positive one, but still have a bearish delta, right? If the market's at resistance overextended and the RSI is overextended, and you expect the market to pull back into support, there's no problem. Even if you're bullish in the market, there's no problem and there's no issue adding a couple bearish trades. And that's what I think is important right now, is to offset some of that risk, because most people carry bullish deltas. Would you agree with that? Most people do.
I would say 95% of traders carry
95% of investors, traders carry bullish deltas.
Yep.
When you're positive one in the market, typically you want to carry a bullish delta. And I'll find that portfolio journal that we use at Tackle Trading to kind of do that here in a second. But what I'm suggesting that is, even if you're bullish in the marketplace over a trend or a cycle or whatever you're looking at, if your expectation is the market's at resistance, as the market's at resistance, and it's going to pull back just a little bit, add a couple bearish trades to the portfolio to offset the delta risk. Does that make sense?
Yeah, it completely makes sense. And, learning how to filter for both sides is a very important thing. The second you said that, I went and started clicking some buttons on FinViz, because I want to go find a candidate that's in a bear retracement type situation,
or breaking support or something like that.
Something. And that is where delta hedging and beta weighting comes in. There's a lot that goes to that. There's a lot of companies out there selling off today. There's no doubt about it. And if you're a good trader, you can always find something to trade, right?
All in all, and I don't want to be misunderstood here, I am bullish on the U.S. economy right now. Okay, the reading of 4.1% is a good number from an economic standpoint. That doesn't necessarily mean it correlates to the market responding to the number. You have to focus on the price action. The U.S. economy, even if you grow in the third quarter and the fourth quarter, even if you grow at the average, Tim, if you grow at the average, third quarter average is 2.5%, fourth quarter average is 2.1%. So let's just project future. If you grow at the average, you're going to grow at 2.75% this year, which is a good number. It takes time for the U.S. economy to really start kicking. So I'm suggesting that the U.S. economy, from an economic perspective, is a growing economy, is showing signs of strength, but that doesn't mean the market has to be correlated to that.
Got it. Yeah, I agree with that. And there's so many things that you go through on a day-to-day basis. And this is why I've always said this: the market is an ongoing conversation. And I explained it once this way, Matt. It's like you're a painter that you're constantly painting. You never stop putting your brush down, because today we now have new information. The conversation moves on. On Monday, we'll have new information. The conversation moves on, right?
The last bit of economic news very quickly, Tim, was consumer sentiment. Consumer sentiment, the expectation on consumer sentiment was 9.71. That is the University of Michigan Consumer Sentiment Report. And for those of you who are not familiar with the University of Michigan Consumer Sentiment Report, it's a survey of 600 households around the U.S., basically just asking them a series of questions on whether you're bullish, you're bearish, you're worried, you're not. And that came in at 97.9%. The expectation was 97.1%. That is a good number. And why that's important, ladies and gentlemen, if consumers are happy, and I want to ask everybody this question that's watching the halftime report, if consumers are happy, what are they going to do with money? They're going to continue to spend that money. And so consumers are happy. Amazon sales are happy. I don't know about Amazon, the stock right now, but Amazon sales are very, very good. That's a reflection of positive consumer sentiment as well.
Let's dig into some of the charts for sure. Let's start with, you've got the ES here. I do want to take a look at some of the cross index analysis. Look at YM and NQ, and then end on the RTY. YM probably has the best strength in the market today from a relative perspective. The S&P is down 1%. This is only down 0.4. NQ is getting beat up like the S&P 500, which is the NASDAQ. You know, obviously a red candle there. Finding the 20-day moving average, that's actually a technical catalyst in some ways. You don't catch a falling knife. You'd have to go down to intraday. But the one I want to talk about, Matt, is RTY. And I've been highlighting this throughout the week, and you've been talking about it. Relative weakness in small caps, you know, as we've been moving into this new market. The weakest market today, down 2%, RTY. What's your take on that?
It's breaking its trend. It's breaking the moving averages. It's showing a tremendous amount of bearish activity here today, getting absolutely slaughtered, down 2%. A 2% movement in the markets when you're at, you know, 7,300 on the NASDAQ, 2,800 on the S&P, you know, the Russell 2000 at close to 1,700. A 2% movement is a massive, massive movement when you're talking about how large this market is right now. I'm showing a lot of weakness here. I was expecting a breakout of this cup and handle pattern. I was ready to buy this coming into the breakout. Once again, the key is it's always important to wait for confirmation. So I was a little surprised by the relative weakness over the course of the last few days, but this is certainly concerning. Breaking the support level here at 1680, moving averages both the 20 and the 50. It's underneath right now. I expect that to continue to fade down. Ugly chart.
That's a broken cup and handle. There's no doubt about it.
That's a negative one on the Richter scale.
Yeah.
That's a negative one bearish.
On the Richter scale?
Richter scale. That's what I said, Richter scale.
All right.
We're just giving it. We're just making stuff up right now.
I like it.
But no, this is extremely weak in the small and the mid cap stocks. Once again, they were showing so much strength in April, May, and early June, but showing relative weakness throughout the summer months. I expect this to continue. Perhaps that next support level you want to look at here, Tim, is 1640 on the Russell 2000. It was a short-term resistance level. It was a fairly important support level in June, late June, early July. I expect that level to come back down to 1640.
Interesting. Let's move on to the dollar, then all the commodities. And there's one commodity you wanted to bring up today. We'll end on that one and kind of have a conversation about it. Yeah. Dollar's in a range, been there for a while. We've hit this one all for 2 months about how this range is developing. It's going to be really fascinating for me to watch how this one plays out, because it's the biggest investment in the world, Matt. You would think, a positive GDP number of 4.1%, growing U.S. economy, the dollar should strengthen. It's not as bad as the other candles today, but it's a red candle. Didn't have any follow through.
You know, if like I was saying with the market not necessarily being correlated to the economics, the dollar is typically correlated to the economics, right? So a strengthening economic system usually strengthens the currency. A decelerating economic system usually devalues the currency. And so when you're looking at this from a strength perspective, you would expect the dollar to rise. But like I said, I'm not reading that report as that big of a positive for the U.S. economy. Again, it came in under the expectations. And when you look at the actual report, it was not as good as what people expected it to be. And so because of it, and it's almost like, like take Facebook, for example, Tim. Facebook saw a 30% year over year increase in sales. They literally did over $13 billion in sales. And this is a company that doesn't own anything, and yet they went down by 20% despite that. It's always about the market expectation. It is not about the number. I cannot say that stronger enough. It is about the expectation versus what the number comes in at. So a reading of the expectation versus the numbers is like bearish indicator.
Yeah, I agree. As the dollar is neutral here today, many of the commodities are neutral, but there's a couple of them here. Crude oil down 43 cents. If you're a day trader in crude, you know that on Friday there's an oil rig count that comes out here in about 9 minutes. could make a move on crude. It has the ability to make an impact, but it's not like the EIA numbers or anything else. That's the Baker Hughes.
I just think it's boring right now. Baker Hughes comes out. It's on Friday. It's a rig count for international, American, and Canadian oil rigs. Have been doing it since 1944. It certainly can move the market, but I'm kind of going into my bullish trade on crude this weekend, not worrying about it. I'm a little concerned at the 70 mark. Little concerned about the 70 mark, showing intraday resistance levels here. But overall, I'm not that big of a concern about my bullish trade here.
I think from a relative strength standpoint, you compare it to some of the indexes we looked at, crude actually looks a little bit better from a short-term perspective. Gold and silver, the metals markets, and I do want to position this against the palladium call that we're going to look at here in a minute. Metals have been bearish. We've talked so much about it in gold. Gold's been down, 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 down. Green candle today coming back into that 1240 range, Matt. Now, let me kind of paint a picture in the future. What if it hits 1240, dojis, and then confirms on a red candle? That's a perfect swing trade.
That's a shorting opportunity.
Yeah, I would agree with that. So you kind of have to project that stuff out days over days. I would not short it on a green candle today. Silver also got a green candle, but I want you to highlight palladium, Matt, which you and I were talking about before. I was having a conversation with young Cody, who you mentored, right? Mm-hmm. And just on, I think it was on one of our coaches' shows or something, he had mentioned palladium. And I don't know the answer to this, but I think that the fundamentals on palladium are a little mixed. We need to get Pete Thomas back on the podcast and talk about it.
Pete's our expert.
And Cody was saying he was interested in the palladium coins. And I'm like, well, I think there's a huge premium in those coins, and they might be more hype than actual fascination, because I was interested as well when they first came out. This chart's ugly. I wouldn't buy palladium here.
If you wanted to, I'd sell it to you.
I'm sure you would. That's a market, right?
That's the U.S. economic system right there. Hey, I want to buy palladium. Well, I'll sell it to you, right? Okay. I was going through my morning routine today, and typically when I go through my morning routine, Tim, it's I look at the indexes first, I look at the sector second, I look at the major commodities third, your gold, your silver, your oil, your natural gas. I usually don't look at platinum and palladium, I usually don't look at that. But, Tim, I was kind of on Taco Trading's Skyline here. And this is kind of where I just quickly do my daily routine. It's a very, very easy way to just get all the information you need. I'm looking at here, it's right here in the Trade Center Market Skyline. I'm looking at the heat maps to kind of get an identification of what's going on today. Obviously, technology getting absolutely butchered here today. Not a lot of positive to really kind of take away from the heat map if you're bullish today. Then I scroll down and I look at the major indexes just by clicking on these.
Well, and stay there for a second. Stay there on that heat map, because I want to quiz our audience right there. When you see the heat map, what do you see? And they're going to answer as you go through. But what is the first thing that stands out? Because I agree, Matt, when I'm on that heat map, that stands out. That big red chunk in technology stands out. But I also saw ExxonMobil. Right?
And I also saw some of these, some of the healthcare sector, right? Some of the outside of the drug manufacturers like Johnson & Johnson and Eli Lilly and whatnot. There's a lot of some deep red here in biotech today. Luminana down 3.8%, Amgen 6.1%, Celgene 1.5%, Gilead 1.3%, Biogen, Regeneron, all of them getting absolutely butchered today. So that kind of stood out to me. Technology stood out. Biotech really kind of stood out. So, when you're looking at the heat map here, you're really just trying to generate ideas is really what you're trying to do. Mm-hmm. An idea might be, oh my goodness, technology is getting butchered. Let me go look at the tech sector and see what's going on. Maybe I need to protect some of my investments out there in technology, mm-hmm. or maybe I need, if like I was talking about earlier today, if the market's at resistance and you expect it to come down into support, maybe you want to go find a short-term short position, right? Just even a 2-3 day short position, maybe you want to look at ExxonMobil or some of the biotech or whatever the case is. On the flip side, Tim, here's Altria Group, right? Up 2.69%. Market's going down today. Both Philip Morris and Altria Group. I guess people are still smoking some cigarettes out there. Like I said, the drug manufacturer sector is doing pretty decent. Verizon, AT&T, both up very good here. So yeah, when you're looking at the overall heat map, I'm generating ideas based on what I want to do in my portfolio. The next thing I'm looking at is I just kind of look at these indices right here, just from a trend and pattern perspective. And I go down through the commodities right here. And when I hit palladium, and again, I usually don't, I hardly ever trade palladium. Okay. So I'm just kind of going down my list here. I'm looking at gold, silver, crude oil, all that jazz. And then I came across this chart, Tim, and it just stood out to me how ugly this chart was. And, you know, I'm looking at it, okay, well, let's go look at palladium on the chart here. Tremendous bearish downtrend, showing increasing momentum to the downside, retraces back up to a very important support level, now resistance here at about 940. Confirmation candle today. I'm looking at that as a potential short position here to perhaps give me some bearish delta.
Yeah. There's no options on it, by the way.
No, you have to trade the futures, or you have to trade, that very illiquid ETF.
Well, PAL has some volume behind it. I just don't think they price options on it. So they're and the options on futures,
you can't do them. You have to actually short the futures, or you have to short the ETF.
This would be a straight play. And I like it. I think it's an interesting call on this one. Candles coming back, red candles triggering into a 20-day moving average, old support, new resistance. Well,
let's track this one next week. I'm calling a bearish call. I'm calling a bearish call on this underneath 940.
So stop at 945.
Stop would be placed at ATR 41.29. It depends. If you wanted to give it a little bit of room, it would have to be above 950. If you want to be a little aggressive on that stop loss, I would say 945.
Well, I would probably want to have at least a 2-to-1 reward to risk ratio on a directional. So if I'm at current price 920, basically 919.30, 60 points down, 20 points up puts my stop at 940. I could do 30 points at 950. You could go to 950 on a stop.
Yeah.
I think you've got to get above the 940 mark because of the high of the candle 3 days ago, Matt. Right?
I agree. You have to be above 940.
Yeah. All right. Interesting. We'll track it. I like it. Let's keep an eye on it. Bunch of stocks in the news today. Obviously, we got to look at Amazon. We spent so much time on it yesterday. And Matt, it was funny. You and I and you tweeted about this. Matt and I were hanging out on the phone, and we tried to price like 8 different strategies on this, Matt. Mm-hmm. We tried to do everything we could on the risk graph. I couldn't find a way to trade it. Crazy. No. Yeah.
I literally said there is no trade I feel comfortable on this. Now, obviously, short strangles would have worked. Iron condors would have worked. Those would have worked here. But, looking back, I don't regret not playing this position. Amazon, it was kind of a wicked type movement. I mean, up 80 points, down 80 points. It's really kind of a muted response. I went through their earnings report, Tim. Amazon had an absolutely amazing earnings quarter. They destroyed that. They doubled the expectation on earnings per shares.
Yeah.
In almost every single category, they exceeded the revenue projections outside of, I think, just maybe 1 or 2. But what was really kind of astonishing to see is to see some of the growth in some of the things that you don't even consider Amazon. Like I've been saying for years, for a couple of years now, that one of the reasons why I like Amazon is their AWS server. Is one of the reasons I like Amazon.
40% of the revenue, Matt. 40% of the revenue comes from AWS, I believe. If I'm looking at the data right, but that's what I read as well. They're growing in amazing areas on the back end and on the actual data storage, on the things that most consumers don't think of when they think of Amazon.
When most consumers think of Amazon, you think of the actual retail side of Amazon. And the retail side of Amazon is still their biggest total revenue generator, no doubt about that. But from a profitability perspective, their biggest profitability from an ROI perspective is that AWS server. And that thing is growing at massive numbers. And that is something that is a growth type industry. Google's into it, Apple's into it. There's a lot of other companies into it that are doing good. But there's nobody that touches that server based like AWS does. They do a great job.
I agree. You know, the thing about this candle here, we're now flat for the day, but that's a huge red candle, obviously. Look at the percentage up there, man. Almost literally just zero.
If Amazon turns red on the day, I know the candle's red, but you're still up, what, 24 cents on the day? If Amazon turns red after that blowout earnings, after this, immediately after the earnings report, okay, this immediately after the earnings, don't mind all of that stuff. That's nothing. This immediately after the earnings report, and then once the market opens, everybody just locks in profit. I'm taking this on Amazon. This is not an anti-Amazon. This is a market response. This is the market coming down today. People got a little concerned, locked in profit. I'm not taking that too big of a situation though.
Me neither. Actually, now that I mean, if you look at that, volatility is already down at 28%. Stock's still in an uptrend. I don't think you buy going into the weekend.
Oh, heavens no.
No, but I'm obviously going to continue to watch Amazon every day. It's a key stock, key component. And if it settles into those moving averages, you know, and either through a time correction or a price correction, I would be interested in that next week. There's no doubt.
This is my target where I would love picking up Amazon.
Yeah, let me ask everybody out there, buy, sell, or pass on Amazon. You know, right now for me, it's a pass with the candle and the weekend. But buy, sell, or pass on Amazon.
1750 is my target that I want. You know, and it's like you say these things. I want it to come to 17. It might never come to 1750, and if it doesn't, I won't make a trade on it. But that's what I would love to see is for Amazon to retrace back down into that 1750 area. It's a previous level of resistance. It's right between two rising moving averages that will give it. And think about it like this, Tim. Volatility, how long does it take volatility to really kind of come down and level out after earnings? 2, 3, 4 days?
Yeah, maybe even up to a week. Sometimes it's only 2 days, but sometimes it's up to a week. I think this one still has some volatility to drop.
Well, and as you can see, you're starting to see that right here. So you give it 2 or 3, 4 days, let kind of the volatility settle out of the earnings. Maybe the market comes back down into support at that level. I would love picking it up at 1750.
Yeah, really, really interesting. Love the stock still. And I was very impressed by their earnings report. You know what's amazing, Matt? This company forever was losing money. And now they're starting to turn profits and they're starting to grow earnings and revenue. And that's the whole point of why they've been a juggernaut.
You know, it's amazing when you think about that. They only made, and I say only, in their retail side of their business, they only was, about a $1.2 billion profit?
Yeah.
About $1.2 billion profit, and yet they're a $900 billion company that is one of the fastest growing markets. It's because where people expect Amazon to be 20 years from now. They just recently turned profit in 2015. But because of the debt-driven discussion, Tim, it did make me think about another company that you're looking at here on Spotify. Right now, a debt-driven company on Spotify just recently had earnings. They were expected to miss earnings per share at 0.70 cents. So they were supposed to have a negative 70% on earnings per share. They got absolutely beat up on that in terms of negative 2.58. Are you looking at this from an investing perspective after the earnings report?
I want to buy it so bad, but I can't. I can't buy on that.
Well, you like the company.
Yes. Here's the thing. You know, one of my buddies and our friend, Steve Andrews, he says this to beginners all the time. Guys, picking stock's not hard. You've been a consumer your whole life. You've been doing market research your whole life. What companies do you like? You know, that's investment advice that you've been training people on for a long time, Matt. Mm-hmm. I love Spotify. I know they got a good service. I know they got a good company from that perspective. And the IPO has been one of the better ones to follow through on an IPO. For years, Matt, we've been seeing IPOs come out and then settle in. This one IPO'd, it's been in a juggernaut uptrend, but that's an ugly candle. You can't buy on that candle.
No, it's down 6% today. Obviously, a very negative response to a very negative earnings. You can't take it in any other capacity outside of that. But that doesn't mean you can't look at this as an opportunity to maybe pick an area where you're comfortable entering into that from a long-term perspective. You know, the fundamentals of Spotify are going to be ugly. They are. You look at the Analyze tab on the fundamentals of Spotify here. You're looking at a very ugly company here, Tim. Okay. Yeah. I mean, they're increasing their negative earnings per share. Their PE ratio is not, you can't even look at it because it's a negative PE ratio. There is no fundamental reason to invest in this. But you know what, Tim? There wasn't a fundamental reason to invest in Amazon for the first 10 years of that company.
Yeah, that's right.
You know, and so it's more of a, it goes back to the belief that the Warren Buffett value investor, right? You're an investor, you like Spotify, okay? Everybody that's watching the halftime report, how many of you use the service Spotify?
Well, and obviously their competition would be the Pandoras, the iTunes, the Apple, music kind of stuff. I personally like them. I think they're great. I think they're the best way to listen and stream to music, especially if you pay for premium. It's an incredible service. So
there's no reason not to pay for premium on Spotify, right? It's a cheap subscription that gets you access to millions and millions of songs, building your own, list. It's a great service, no doubt about that. This earnings announcement shouldn't stop the value investor from picking up Spotify. It has a lot of risk, right, from an investor perspective. It wouldn't shock me to see Spotify go from $184 down to $50. The same way it wouldn't shock me to wake up 2 years from now and have Spotify at $350. That wouldn't shock. It's got big return, but it also has big risk.
I agree. And the price tag at 184, obviously. And you know what's really interesting about these IPOs, Matt? And it happened literally within a week. The options are liquid. They're liquid amazing. As they come. It's pretty crazy. Amazing. Another company I like from an IPO, we'll look at it in a couple of weeks, is Dropbox, DBX. And they've got earnings coming out here in a bit. Not exactly the same kind of chart, though, is it there, Matt?
No, it's not. Absolutely not. But Dropbox is another company I am interested in, Tim.
Yeah.
I'm not yet, but it is I use Dropbox. I like Dropbox. Our company Tackle uses Dropbox. Trading Justice uses Dropbox. We store all of our stuff there. We pay a premium service for it. It's similar to the same reason why I like Amazon from an AWS server perspective. I like using their servers. They're very easy. They're very secure. I don't have any issues of privacy concerns or sharing data or whatever the case is. So obviously, I'm not going to touch this coming before its earnings, but after its earnings, that is something that I do want to look at from an investor perspective.
I agree. You got to look at Intel as well, Matt. Tackle 25 stock. Not a good day.
It might not be after this quarter.
Well, we don't reset.
We don't cheat. We don't cheat. Obviously, we don't cheat. We don't do what the indexes do. We don't do what the hedge funds do, and we don't do what the institutions do, who kick out bad performers second, third quarter in the year to add the new performers to make them look good. We don't do that. But I'm saying at the end of the year, if Intel doesn't turn it around, we're going to look at this day as the reason Intel gets kicked off the 25 list. Just absolutely getting butchered out of its earnings report. Earnings report actually came in slightly above the expectation, but growth concerns are there, very similar to what Facebook has. Revenue concerns are there, forward projections are a concern. Intel down 8%. And this is not a company that moves a tremendous amount on earnings, Tim. It's a very, very established liquid company. This is a massive move for the investors of Intel. There's been selling follow through after the opening price earlier today. I expect that to continue to come down.
It's an ugly chart, and when you gap specifically right below the support point, Matt, it's the kind of thing for a technician that's got to give you real concern. I mean, I like gap fills. We talked about them several times this week. This is one I'd be a little bit cautious on. Now, if I saw some intraday strength, that'd be one thing. Facebook also. Ugly, whole market down today.
You said something that made me think of something. You said it gapped under the support level. Those things are important. They're very important because there's stop losses under support levels. That's where people place stop losses, is under the support levels. You look at this on Facebook here, Tim. It actually gapped up. And what did I say yesterday? I'm looking at a potential trade above what level? 180. 180, because that's where I identified intraday resistance level. Tim, I want you to see something here on Facebook. Facebook gapped open today at 179.87. It hit the high price of 179.93. And then right after that, right after it hit intraday resistance levels, you can see it really right here, once it hit these intraday resistance levels, just got absolutely beat up. This same concept applies if you go above the resistance levels. And so coming back to Intel here, Tim, if it would have gapped down into support, you might have a different perspective. If it comes into this level right here, you might have a different perspective from an analytical point of view. But because it gaps under, starts triggering these stop losses, I don't know how anybody couldn't expect it to come back down into these support levels between $44 and $46.
Well, with the whole market down today, obviously, we're going into a Friday. I would agree. Until you see some other price action, new updated information, you got to be very, very cautious there with that chart. Twitter, we spent a lot of time on. That stock got destroyed, Matt. Now you've been waiting for your long-term opportunity. You're a fanboy of Twitter lately.
Mm-hmm. I am.
Same thing with Spotify. I mean, this is a different candle than the other one, in my opinion. Okay.
Oh yeah, this was worse.
Yeah.
I mean, I felt like the inverted fly was the only way to go on Twitter yesterday.
Yep.
That's what I personally felt. I felt like I felt like it was going to move more than the market maker move. Twitter had a tremendous amount of price appreciation over the last quarter. I felt like earnings had to be a blowout number. You know, you're talking about a 30% movement up growth over the last quarter. They obviously did not do that. They came in at 17 with the expectation of 18 cents. In some new traders, they might say, well, Matt, that's a slight miss. Well, guys, it's about the expectation. When you've had this type of growth, 30% in the last quarter, you can't have a slight miss. You have to exceed the expectation because people are buying it because they think you're going to continue to exceed the expectation. However, I am looking at this as an investor perspective, you know, and Twitter is one of those companies very similar to Spotify, Tim, has tremendous growth potential, has buyout potential. But with buyout potential and tremendous growth potential, what also increases?
Risk
Increases. You're not looking at investing in General Electric here and getting paid a 2% dividend. This is Twitter. You're buying it for
Hold on. Time out. Put up GE.
It was a bad example.
Time out.
Bad example.
Twitter or GE? I would take Twitter in a heartbeat.
Okay, let's put it out there. Twitter. Of course I'd take Twitter. I wouldn't buy GE, but I'm saying GE's not that one that's going to have a blockbuster growth potential, but it does have blockbuster bearish potential. There's no doubt about that.
Well, I will tell you this. I did read an interesting headline about the new GE kind of business plan right now. They're contracting for the potential to grow, you know, and really.
Wait me when I care.
I know, same thing. But Matt, they are in a developing downtrend reversal pattern. They've got support down there. I would not invest in GE. There's no doubt. If you ask me Twitter or GE, I do Twitter in a heartbeat, you know, because I look at the potential.
How much time did we just spend on General Electric?
Well, you're the one who brought it up.
30 seconds. I know. I regret it already. 30 seconds. The worst 30 seconds on the halftime report was us analyzing General Electric. I kid, but it's.
I met a student about 6 months ago, though, and I remember we were in a class in Phoenix, Arizona, and I asked everybody for their favorite stocks, and she said GE, and I instantly, as a mentor, knew that meant that she's been holding it for years, and she was too stubborn to let it go. You know, sometimes your little baby that you have, you look down, and it's not what you thought, right? GE has been a darling for long-term investors for probably 50 years or more, Matt. And it's just not, you know, get off of this chart right now.
Okay, hold on. I brought it up for a reason, though. I brought because I want to get back to Twitter here for a second, but I did bring it up for a reason. Okay. This was GoPro. Okay. This was GoPro. Let me bring it up. Hold on. I need more time frame because it took more than 3 years. So let's go 10 years. All right. This was GoPro on its IPO, right? We're looking at weekly. This is what I talk about with the massive growth potential versus the massive risk potential. This is where Spotify is right now. Now, Spotify could be that one that just continues to go up. No doubt about that. But it has this potential in it, right? Twitter has that same type of potential. You look at Twitter here, massive growth when they IPO'd. And then look what happened. The question on Twitter is this now a situation where you're looking at this from a buyer's perspective? I remember when Facebook came out IPO at 38, and Tim, I said, I would absolutely not touch Facebook's IPO at 38. Absolutely not, because I felt like Wall Street was going to sell it. They had some business model concerns and consumers were going to buy it. I felt it was going to come down. But I remember making a statement in one of our shows, Tim, many, many years ago, when I said, sometimes the hate goes too far, right? And the hate on Twitter certainly went too far, where it found really strong support, double bottom support, W formation, breaking out of resistance here at 25. It's had great follow through on its trend developing over the course of the last really kind of year, I would say. And so right now, when we're looking at Twitter, yeah, this is a real big, ugly candle. But Tim, this is a very consistent trend line. And remember what I said, if it cut, I need it to come back down into its trend line. And that's exactly what's happening. I think it's an overreaction to the earnings announcement. Maybe that's because I wanted it to come down, but watch this puppy come into that trend line. I'm waiting for confirmation. Tim, as an investor, it might take a month for me to make that decision, right? Because I'm going to need it to slow down over weeks, right? So, but I am looking at this from a potential investor perspective. And yes, I do like Twitter. It's better than Facebook.
Well, or you could just slingshot that thing, buy 100 shares and 2 put options in January and have a V-shaped risk graph. You're going to get volatility. I mean, there are things you could do. I'm going to put that one on my research list. Probably going to look at it by the end of the day and maybe even next week. You could easily pick up the equity. And if I'm buying insurance for this kind of thing, Matt, I'm probably getting January. I know the volatility is still sky high at 49%, but that at the money option, it changes yep, very good. That way, if you get a good move to the upside, you can catch some of that. And if you don't need to overhead, you can just do one insurance contract, obviously. But I like the two.
Well, I actually like ratioing when you're doing stuff like that. And what ratio spread means, guys, is you're offset on your contract. So you have 1 put, 2 calls, or you're buying the stock and you have 2 puts. Basically, I like the ratio when you're doing something like this, Tim, because it creates the V-shaped risk graph versus when you just do one contract here, it creates a flatline risk graph, right? So it controls the risk to the downside at a certain level. I personally, and if you're very conservative and you're protecting your investment long-term, I'd like that. But if you're looking at something playing both sides of the equation, having the ability to manage the trade a little bit more freely, I like doing a ratio on this. That's not a bad call, Tim. I'd still want to see it slow down first. Let the volatility come out of it a little bit over the next 2 days. But that's a really, really good idea. It's something I'm going to look at early next week. Thank you for that, by the way.
Hey, ding, 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 ding. That's why we do this, by the way. The whole point is to share ideas and think through about things critically.
Tim, that was honestly, that last 5 minutes was what you and I have done together for the last 13 years every day. Just talking shop, talking markets, expressing ideas. Sometimes we agree with one another. Sometimes you say, Matt, that is the dumbest thing you've ever said. And sometimes I say the same thing to you. But at the end of the day, that's what a team does together. We talk, we discuss, we generate ideas, generate thoughts. But at the end of the day, and I want this to be very, very clear, when I make a transaction, I am responsible for that. I am responsible. When Tim makes a transaction, he is responsible for that. Yeah. We do not give investment advice, ladies and gentlemen. You are an individual investor. You are part of our team. But when you make a transaction, it's not like, we're going to cover your risk, and it's not like you're going to pay us some of your return, right? You make your transactions. You own the return. You own the risk. You own the responsibility.
100%. Yeah. I mean, there's no debate. Twitter
that was my disclaimer without having to actually disclaim something.
What's funny though is that when I do that, you go off on a rant about how we have too many legal disclaimers.
Because I do it a lot trickier than you do.
All right, say love me. Let's move on. There's several other companies that we got to look at for next week, Matt. I want to kind of do a peek ahead. Let's do this on FinViz. Do you have that link I sent you in the chat?
Yep, pulling it over.
On Friday, I always look ahead at the week coming up, and kind of start to think about it and how I'm going to plan for it and whatnot. By market capitalization, next week, Apple, Berkshire, Royal Dutch, Pfizer. Obviously, Apple Computer is going to be the big one. We going to hit $1 trillion market cap next week, Matt?
No.
All right. Going to be interesting. Pfizer, Procter and Gamble.
By the way, it does not have to move much to hit that $1 trillion mark.
No, it does not. It does not. Apple's on its way. There's no doubt about it. That's going to be the big headline. But then you've also got Baidu, Caterpillar. As you dig further into that list, you're going to find companies like Tesla. Which companies are really standing out to you that you got to pay attention to?
Well, obviously Apple is the big dog. They're up there with Amazon, 1A, 1B in terms of the importance to the market as well as market cap. I've always really enjoyed Berkshire's earnings announcement, and I really enjoyed, the conference calls and, listening to those amazing investors over at Berkshire talk about their markets and whatnot, what's working, what's not working. So, I'm not an investor in Berkshire, but I do really admire Warren Buffett and what he's done from a value investing perspective. So I've always looked forward to reading the reports and listening to the conference calls and all that just coming out. And his newsletter is one of the best out there in the world, no doubt about that. Outside of that, I'm looking at Baidu next week. Baidu is a very important tech stock from an e-commerce perspective out of China. From an industrial perspective, I am looking at Caterpillar next week as well. Those are some of the major ones with the biggest market caps. When you kind of come down the list here, I like looking at, it's amazing, but Activision, this is a massive, massive gaming company, probably the biggest gaming company out there in the world. It's a 60 billion market cap company. That was actually one of my sons, as I was talking to him about value investing, speaking about Warren Buffett, he was looking at GameStop, Activision, as I was kind of talking to him about value investing. I'm looking at Activision. This is the one I'm looking at more than any other one. And I know it's kind of weird to think about that because it's not as big as some of the other ones, but Tesla is in my mind right now. And Tesla, you look at Tesla, you look at everything that's happened on Tesla coming in, you look at all the different negativity surrounding Elon Musk and Tesla right now. And I'm looking at this earnings report as a potential to absolutely have to me, I would be only shocked with a muted response.
Yeah.
I would not be shocked with 10% up, 10% down. That would not shock me at all.
Are you kidding me? Nothing could shock me right now.
I'm going to blindly trade an inverted butterfly on Tesla next. I won't even look at the market maker move. I will blindly trade an inverted butterfly on Tesla next week.
Well, to get your fill, you may actually want to price that today or Monday. Sometimes
it's not going to be. I made that mistake yesterday with Twitter. I'm sitting here on the halftime report talking about doing an inverted butterfly on Twitter. Then I spent the next 2 hours trying to get into the inverted butterfly on Twitter.
Sure. Yeah. Sometimes if you wait till the last day right before earnings to get a fill within 2 hours, the bid-ask spreads can open up. Mm-hmm. It can be very difficult to actually get a good price. So you might want to start looking at that one on Monday.
It's really kind of an internal debate, Tim, because if you do it the day before, you're going to get a better fill rate, right? Mm-hmm. You're going to get a better fill rate. You're going to get in easier. But if you do it 2 hours before, you're going to hit the mid price, be able to sell your strikes where you want, right? So it's just at what point do you say, okay, because if I do it on the day before, literally by the next day before they even announce earnings, it might have moved 20 points, right? So it's just an internal debate on that. I'll try to do it before the market, after the market settles down on its earnings day.
Next week on the economic calendar, there are a couple of key events. Over at Forex Factory, I always click on that next week button and kind of look ahead as well. It's going to be Fed week, Matt. If you put that filter down just to the red ones and we take a look at just the red impacts for now, you've got other stuff, consumer confidence, ISM, those things do matter to me. But the Federal Reserve is going to be the story of the week. The expectation, what I saw in the futures market, they're not raising this time, okay? Mm-hmm. That's not what I'm seeing, but what I am seeing is they are expected to raise in September, a 90% expectation for a raise on the 26th September meeting, only a 2% expectation for August. So is this an event you worry about, or how do you play that?
This is not an event I'm too worried about. Like I said, they're not expected to do much next week. But anytime you have consumer confidence, manufacturing data, unemployment, and the Fed all in the same week, as well as 150 major market companies announcing earnings. Expect volatility to the same degree that we got this week. Expect some up and down. You're going to have some good numbers. You're going to have some bad numbers. You're going to have some good earnings announcements. You're going to have some bad earnings announcements. I expect volatility next week.
Yeah, me too. All right, guys. That's Matt. That's all I got for today. 11:30 here Mountain Time. The oil rig count numbers, by the way, just to give you an idea of why it doesn't really do much. They came out and it did move the market though. So if you're day trading, you had about a 60-cent move. In crude oil, that's 2/3%. It did have some volatility there.
Yeah, that's not happened. My bullish trade. Thanks, Rick.
Well,
thanks, Baker Hughes.
But here's the thing. It's one of those things that as a trader, you start thinking, well, now I got to look at that every single week and I'm going to overthink it all the time. In my experience, it does affect day trading, but it doesn't necessarily affect your.
Tim, I fully expected $70 to hold for a couple of days. I'm not going to be too overworked over a couple of days coming back down.
Plan your trade, trade your plan.
Trade the plan. Guys, if you enjoyed the halftime report today, don't hesitate to give us a nice little up thumb. And Tim, you know what? We got the 30 from yesterday. We hit 30 yesterday on the likes, which means I'm going to be growing this nice little beard out, and I'm going to be shaving in the handlebar mustache.
Bring your screen down for a minute. I want to see your handsome face full screen here.
Right here. Growing the beard, right?
Okay.
This handlebar mustache will happen next week. Now, mind you, Tim, I am going to grow it really good for everybody. So it will be next Friday. And next Friday's market recap. When we do the market recap for the halftime report, this will be a handlebar mustache.
How long does it take you to grow a good mustache?
Not as long as you.
Well, it's taken me 38 years. I've never grown a good one. So
you've been spotty. So, guys, if you do like the halftime report, we appreciate you guys liking it on YouTube as well as sharing it with other people. That's going to help us grow this. So really appreciate you guys doing that for us. That's very kind. And as such, I will reward you next week with a handlebar mustache. And then maybe, Tim, will do that. If we hit 50 likes, I'll shave the handlebar mustache. Maybe we'll do that. I don't know.
I think it'll be easier to get people to like it, to make you shave. We're going to see this thing. I don't know. I'll reserve judgment.
They might click the unlike button just to ensure that I keep that stupid handlebar mustache. But so we're not going to do that one. Right?
Let me ask you, do you own a cowboy hat?
I do not own a cowboy hat.
It's because if you're going to grow that mustache, go camping in the Utah mountains, you might need a cowboy hat. We might need to get you a 10-galloner there, man.
Can I just get a Caterpillar hat or a John Deere hat?
Yeah, probably.
Oh, okay.
Yeah, trucker hat. Sounds good. All right, guys, that's it for today. Go ahead and like and share this. Make sure it's getting out there. We'll see you on Monday. Enjoy your weekend.
And for you pro members, real quick, for you pro members, Scouting reports, remember, they come out tomorrow. Make sure you're watching the stock options Forex futures report. And Tim, I'm going to be putting together the Forex report this week. I just read that. Maybe did I volunteer that?
You did, as a matter of fact.
Okay. So guys, just very quickly, I was the one who developed the scouting reports, and on October 14, 2014 was our first scouting report. And what I decided to do, I was trading some currencies at the time, and I decided to buy and download Camtasia. And I just did a quick 10-minute video on recording what I was looking at trading in the currency market. And I was extremely bullish on the dollar. And that week, that report killed it, Tim. And then I called you and Gino and Noah, and we started putting these scouting reports together, guys. It's a great way to get up-to-date analysts on all major markets, looking at our watch list, looking at our swing trades. So if you're not a member of the pro team over there at Tackle Train, get over there to tackletrain.com, click on the sign up today button, and you can become a pro member of Tackle Training.
Yeah, I mean, first of all, it's invaluable analysis, quite frankly. Even like I'm not doing a report this weekend. I've got the weekend off on that regard. But you know what I'll do, Matt? As a trader, I'm going to sit down and watch every one of those reports on Sunday or Saturday. And
think about it. You get great analysis from Gino Poor, an amazing trader of 20 years veteran trader status. Noah Davidson, 15 years trading in the market. I mean, with all things relative, you and I are the babies of the bunch with Noah and Gino over there. So it's going to be awesome to come out there and do a scouting report again. I haven't done one in a few years, but love analyzing currency. So if you guys want to get that report, it's be about a 15-minute video on me analyzing the currencies out there for next week.
Perfect. All right, guys, we'll see you on Monday. Very good job, Matt. We'll talk to you.